Now, this is a really great example to illustrate how you can use the butterfly to trade high-priced stocks with super low risk using the wide-wing butterfly. So this is an example back on Amazon when it was, trading, well over $1,000 for a long time until they split it. But this really illustrates how dynamic the butterfly can be for your portfolio. So in this example, it was trading at 1,782. So remember, one option contract is equivalent to 100 shares. So if we were to do the equivalent of, buying Amazon and we bought 100 shares, you're putting out $178,200, right? Well, that's a lot of capital. That's a lot of risk potentially. If it goes down, man, you've got a lot of potential risk. All right, so we were looking though for a target up here to this 1830 and been trading right here, chopping around on this support. That's a 200-day moving average. And we were looking for the next target up was this 1830, which seems to hit here, hit. So a lot of hits there. So we were targeting that area. All right, so we did this trade instead of just buying 100 shares outright and paying a lot of money, over 178,000. We did the same kind of controlled risk trade, more controlled risk. In this trade, the way we set it up cost $80, okay? So here was the trade. So we were looking for that target to 1830. It was trading at 1,782. Now, if we bought 100 shares here, we paid 178,200, and we hit our target at 1830, we would be up $48 a share. 2.69% return. Well, that is not too great, if you look at the risk. But for the same type of trade potential, we were able to do this with the butterfly, which cost 80 cents or $80 per spread versus 178,000. Okay, so this was buying, and we were targeting that 1830. So we went out and we bought the 1820 call, sold the 1830, sold the 1830, bought the 1840. So $10 wide spread. 1830 target. Now this has then potential to make that spread width, 18, 20, 30. You can see it's $1,000 wide, less the cost of the trade. Potential to make $920 on that risk of 80, 1,150% return. Risk $1 to make 1150 versus making 2.69. So tremendous type of trade that you can do, okay? So here's just your risk profile. You can see right here, potential to make 920, risk of $80, and there you go, bingo on that, But if you don't get that perfect pin, you still make a ton of money, and especially return on your capital. So here's the other thing I wanted to point out, though. This is what makes them so dynamic. You can see all that black area in there. That's what's left. This is the same day. This is on the expiration day of the 6th in the morning, about 10 a.m. So at 10 a.m., it was trading somewhere around 1836.50, okay? But you can see all that potential profit is still in there from the time component that you've sold in the volatility. But it was trading right here, okay? That purple is where it is in time. But it was still up a nice return on the risk. So at this point, it was up at $230 per spread on the risk of 80. So this was up $150 per spread, all right? And that would be a return of 187%. That's still not bad, right? I still take that all day long. 150 bucks potential, and your return then is 187% return on your capital. But here's where the same trade, Amazon, but on the same day, but later in the day, look what the difference is. So this is, towards the end of the day, getting close to the day of that, getting close to the time for the market to close and expiration. Now look what happened to the spread. You can see the tint here. There, look at the black. This went earlier. It was down here. Now it's sucking all the time. The profit and the volatility profit is going straight in your pocket from the time decay going into the expiration on that day. All right, so here later in the day, this thing now has gone from 80 cents or $80. Now it's up to $695, okay? So that is then a profit of $614 per spread. So it's gone from $150 per spread in the morning, which was 187% return. Now in the afternoon, this is 4 times more, and now it's up to $614 per spread, 769% return versus earlier in the morning 187. And if you did the stock, you were up 2.69% return, plus had that huge risk. All right, so that's the beauty of it. So at the end of the day, it goes to zero, and you're sucking out all that additional time and volatility from the short side component of the spread. So great way to trade high volatility, high price stocks, plus the dynamics of that additional spread, credit spread to it, sucking out time and volatility.